Today we are looking at the Microsoft Corporation, ticker symbol MSFT. It is currently trading at $418 a share and is up 32% over the last year. This stock has been an absolute monster. What we're going to be doing today is looking at my automated stock valuation spreadsheet to see if Microsoft is a buy or a sell, looking at my discounted free cash flow models, my comparable companies model, and of course the Ben Graham formula for intrinsic value to see if Microsoft is a buy or a sell. So as I said, Microsoft is currently trading at $418 a share, up 32% on the year. Year to date though, up 12%. So if we compare it versus the S&P 500 over a similar time, no surprises, it is beating the market over the long run here. Over the last year to date, up 32% compared to the market's 26%. Now, yes, year to date, the market has done pretty well. It has rebounded after some troubling times, up 17%. But if we go over the last 5 years, Microsoft has more than doubled it, 207% compared to 91%. So let's have a look at my automated stock valuation spreadsheet. If you want to look at this, please check out my Patreon. Links are in the description, but let's get straight into it. So if you type in the ticker, this will return all of the company's financial data. And what we will do here is look at some of the key details. So as said before, $418 a share, 3.1 billion market cap, 3.1 trillion market cap, my mistake. P ratio of 35. And if we look at the current S&P 500 P ratio, it is 29. So Microsoft is higher than the market average. Earnings per share, $11.80, beta of 0.9, which means it is slightly less volatile than the market, and a target price for around about $500 a share. So analysts are saying it is a buy. Let's see if our models agree. Dividend yield, 0.72%. That's about $3 a dividend per share. Total dividend, 22 billion. Payout ratio is quite high actually, but we'll go into that in a second. Right, now let's have a look at the revenue of Microsoft. So we have here the revenues dating back to 2010, and obviously revenues is all the money that they have generated, and you can see it has been a steady increase up apart from the trailing 12 months. So all-time high was $209 billion, and currently trailing 12 months 199. So obviously a bit of a down slope there, but Microsoft has consistently grew their revenue apart from a few blips in 2016 and once again in 2019. You can see it's down about 5%, but they have been growing at a pretty substantial rate, so some slowness is expected. 14.36% on the 5-year CAGR. Next, we're going to have a look at the net income. This is the earnings or the profit, and currently 67.23 billion, down again from the 2023 and 2022 numbers over compared to those numbers here over the trailing 12 months. So profit is down as well. Next, we'll look at the free cash flow. This is cash from operating activities minus capital expenditures, and once again a similar story, 48 billion, down from 59, down from 65. So we're basically saying this is back to 2020 levels, where they broke their all-time highs and then have dropped down. 13% 5-year CAGR. Shares outstanding, why do we care about this? Well, we ideally want these decreasing or flat. If the stock is, well, if you have one share of a company and there are 10 shares, you own 10%. If they create 10 more shares, they would have 20, you would now own 5%. They would devalue you. If the stock is undervalued, then obviously you buy it. And then if you think it's overvalued, you issue more, you raise capital. But Microsoft has been consistently buying back their shares very slowly, basically from back of 2010, 8.9 billion down to 7.43. Assets, liabilities. We can see here that basically liabilities are increasing while assets, the sort of the gap between assets versus liabilities has been increasing. Microsoft had consistently more assets up until about 2018, and then they've started increasing their liabilities. Now we'll have a look at discounted free cash flow model. What this is a way of calculating a stock price using a valuation method of looking at the company's future free cash flows. What is the value of today's investment based on how much the company will generate in the future? Now, I do not think that this will like it, and you can see why. So the free cash flow ratio is around about $70, and this gives a calculated stock price of $190 a share. Now let's see where these numbers have came from and see if we agree with what the model is saying. So firstly, we do have a look at revenue. Revenue based on averages is around about 9%. What we'll do is we'll have a look at what analysts are saying and see what they are, see if we're in line. So we'll look at the average side. They're expecting in 2025, 225 billion, 2026, 288. Let's see how in line we are with those. 2025, 288. So, you know, let's bring this up a little bit. Let's bring this up to about 11%. And this still makes it $193. Now let's have a look at the other values here. Net income margins. This is revenue divided by net income, and normally Microsoft has had pretty fat net income margins. They have been decreasing recently, so I think an average of 38% is about fair. And then free cash flow. So what we'll do, actually, just in the interest of fairness, we'll have a look at the average of these numbers. Let's bring this up to about 70%, and I still think this is going to be overvalued. Yes, it's a $210 stock. Discounted free cash flow is not going to like Microsoft. Next, we'll have a look at the Ben Graham formula for intrinsic value. This is a way of valuing stocks created from the father of value investing, Ben Graham. What this does is it will look at the earnings per share, PE of a non-growth company, the AAA bond, and then the yield of the current corporate bonds. Now, I do not think this will like it because bond prices are very, very high. Fixed income, corporate yield bonds, AAA, currently at 5.12%. Expected growth rate of Microsoft, according to analysts, is around about... Yahoo Finance has changed that page a little bit, but it does look quite cool. Next 5 years, 13.23, $218 stock. Very interestingly, similar enough to the discounted free cash flow models that we saw earlier. But the one I like looking at the best is the comparables company model. And what this is a way of comparing companies using the metrics compared to other businesses of similar size. So the companies that I'm going to go in, I think their key competitor really is Apple. That they're the most apple to apple comparison. Next, we will have a look at Amazon, ticker symbol AMZN or ZN if you're American. And then finally Google, which is Goog. Now, this is loading the company's financials of Apple, Amazon, and Google live. So once again, check out the Patreon, shilling the Patreon a little bit there. But this brings out some key values. So we have fields that we care about. Revenue, 199 billion trailing 12 months. Apple, these are not the trailing 12 months. These are the last year. Revenue of Apple is 384 billion. Amazon, obviously very high revenue due to their if we split that company between their e-commerce and their AWS or their cloud services, but a lot of the revenue is in their e-commerce, so it's obviously a lot higher than these. And Google, similar to Apple, actually in that 300 billion mark. Growth rate, 5-year growth rate, Microsoft 14% compared to 8, 19, and 17, so all pretty close. EBITDA, which is earnings before interest, taxes, depreciation, and amortization, 130 billion, 131 billion, 104 billion, and 115 billion. So Microsoft is leading the way there. And then finally, profit, net income, 67 billion, 102, 44, and 87. Now, if we look at the margins here, Microsoft does have the highest profit margins of 33.77%, beating Apple and Google by quite a bit. Obviously, Amazon, as I said before, profit margins are lower because of the e-commerce side, where the revenue and the revenue and the cost of that revenue is about the same. Then we look at some other values here. Price to share sales. This is the valuation based on its revenues. 12.69, 8.91, 3, and 6.14. Then we have a look at price to book, which is the value of the stock price compared to its total assets minus its liabilities, 11, 51, 7, and 6. Now, if we do look at the price to sales, the average of the S&P currently is 2.39. Obviously, these are a lot higher. And price to book, we'll probably see a similar story, 5.2. Now, if you look, actually, Amazon and Alphabet are close on both of them. And in fact, Amazon has a price to sales of very similar. Next, we look at the PEG ratio. This is the price to earnings growth. This was popularized by Peter Lynch. 1 is fairly valued, less than 1 is undervalued, and more than 1 is overvalued. And as we can see here, they're all about the same, apart from Google, which is undervalued or close to undervalued. So I think we'll be looking at that. Now, the metrics on the side: EV to revenue, EV to EBITDA, and PE ratio. We want lower is usually better here. Lowest EV to revenue is Amazon. Microsoft is the highest. Lowest EV to EBITDA is Google. Apple is the highest. And PE, you can see they're all about the same apart from Google. So if we look at all of these three companies, this gives a calculated stock price somewhere in the region of $200 to $300 a share. But if we look at the averages, it's $288. If we get rid of Google, because Google does seem to be, I think it's worth looking at Google in another video. You can see this brings the average to around about 365. Now, if we were to compare with Amazon directly, EV to revenue does not like, sorry, Apple, my mistake. EV to revenue is the lowest, but if we look at EV to EBITDA and PE ratio, it is looking maybe slightly undervalued or about fair value. So that is quite interesting to see. Right, guys, thanks for watching the video. Check out my Patreon. If you enjoy it, give it a like, give it a subscribe. I will be trying to do more videos, even though I always say that and then I disappear for months. So I will catch you guys next time.